Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to show you my final tool for valuing precious metals. This is an important tool and it's something I've been working on for years. It's a refinement of earlier models that I have been created, but it will finally show you the relationship of all the variables inside of our markets in macroeconomics today and how that plays into affecting the gold price. And not only that, it's a very valuable tool to be used to value gold and silver as well. The same tool can be used with silver. There's just one minor adjustment that I made to it, but it can give you an idea of where the gold price stands today versus where it should be. Now, in previous models, the best I could do was create a wide ceiling and floor and say, well, gold will trade in this channel. And that was all well and good, but I couldn't really understand and bog down how the behavior of gold and the behavior of the silver price and why did the price fall from time to time and why did it rise. So this is my crowning achievement here. You can use this video and I will post regular updates, but once I talk to you about the variables in this tool, it'll become clear about how it works, and it will also become clear on to the outlook for gold and silver. So there's some good news and bad news with this in regards to the precious metals markets, but I hope that you find this information very valuable. And going forward, I will post updates on this on where this stands, but this is finally a very valuable, valuation tool that we can use for precious metals. So just to highlight the chart right quick, the gold line here is your actual real gold price over time, going all the way back to the 1970s to today. And the blue line is my gold valuation metric. Now you can see here that in large part, my gold valuation metric is able to reliably tell you the behavior of the gold price pretty well. And as a matter of fact, it also indicates certain things about the gold price. It tells you whether the gold price is too high or too low versus where it should be. This is extremely valuable. For example, in the 1970s, when gold was finally just coming off the gold standard and starting its ascent, my gold valuation tool would tell you that gold was very underpriced, that gold should be increasing in its price. And so it did for the remainder of the 1970s. And then something important happened. Gold peaked in the beginning of the 1980s. And my tool would have told you that gold was peaking too high and that there will probably come some kind of correction for it. Sure enough, it did. And then the price and the tool model flowed together. So it told you that gold more or less was being priced pretty appropriately from the 80s into the 90s. And then at the turn of the 1990s, then the tool started to increase very rapidly, and it would strongly point to you that gold was going into a bull market. And then the tool stalled out at about $1,000 an ounce around 2008, 2009, and it would have told you that gold soaring up to $1,600, $1,700 an ounce was unsustainable. There would be a correction. Sure enough, there was. And then from basically 2014 all the way up to the beginning of the COVID pandemic, the tool's model, and the price flowed and fluctuated very closely together. So taken together, it's a very valuable metric that can be used to tell you whether you're getting bang for your buck with buying gold and whether you should wait or whether you should buy now, possibly if you want to sell, or whether it is a lucrative investment like it was in the 1970s. On an absolute scale, you can see more of the variances between the tool model and the gold price, but largely they flowed well together. So what did I put into this tool, this blue line, this model, to get this such relatively accurate measure of gold's value? Well, there's two major factors, and then there's some contributing factors to it. They all piece in together to affect gold's price. Now, the two major factors shouldn't surprise you, and they are the money supply as measured by N2. That's a no-brainer. The more money that comes into the economy, the higher gold's price will become. The same is true with silver. And the value of the dollar index, how the dollar is trading against other currencies. And that's something that I was missing in my other model. I knew that I wanted to incorporate the dollar index, but I did not have the data and until recently, and I started, getting and acquiring that. And the other part was that I couldn't make it fit into the model. And the reason why was because I was missing one other part. And that is the value of the stock market in relation to where the stock market should be valued according to the 30-year Treasury rate and economic growth. That was something that I was missing. Before, I was valuing the stock market in relation to GDP using the Buffett indicator of sorts and was putting that into the gold model because I was thinking that's where the stock market should be, and the fact that it wasn't meant that the money flows were going into gold. That's not the case. What's happening is that the stock market is functioning in relation to interest rates. And because of that, whether the stock market is too high or too low compared to that valuation according to interest rates and GDP growth, if it's too high, then that will depress the gold price. And if it's too low, if the stock market is undervalued compared to where interest rates say it should be, then gold will be overvalued. Why? Because of a missing component of this analysis. And that is that interest rates also affect precious metals prices. The higher interest rates go, the more depressing that gets onto the precious metals. The lower interest rates go, the higher precious metals price goes into. Well, what about inflation? Doesn't price inflation affect the gold price? No. Why shouldn't it? No, because price inflation is an effect and not a cause. What is it an effect of? It is an effect of a rise in the money supply, and that's one of the major components and is the major driver of the gold price. The more money that gets printed, all things else being held equal, the higher gold's price will become. So, what happened here that caused gold to peak in the early 1980s? Did investors just wake up one morning and say, wait a second, guys, hey, gold's too high, we're going to sell? No. Was it rising interest rates? Not exactly. It was the rise in the value of the dollar. Rising interest rates played a part, but as long as the stock market was valued appropriately and that relationship didn't change, that won't affect the gold price. What affected the gold price here in the 1980s was that the dollar index compared to the basket of currencies, the pound, the yuan, the yen, and several others, it nearly doubled in a matter of 4 to 5 years from 1978 to the 1980s, and that depressed that gold price. And it sort of peaked out in 1985. So that's what kept gold from continuing its ascent over time. And then later on in the 1990s and so on, it started to be priced appropriately according to the model. So then what happened in the 1990s that caused gold's real ascent here? Well, one of it was an increase in the money supply by Alan Greenspan to get us out of the dot-com bust. And another part of it was that the dollar index started to cool. The dollar started to drop in relation to those basket of other currencies. That also ascended gold's price. So what about gold today? Well, the good news is that gold is underpriced compared to where it should be. That much is true. So where gold's price should be is about $2,300 an ounce compared to it. The reason why it's not higher is because the dollar has been relatively rallying in the last year because I assume that foreign investors are piling into dollar-denominated assets due to deteriorating global economic growth. And I know that sounds crazy because price inflation is going up here in the United States, but price inflation is going up everywhere. So ultimately now the driving factor is going to be the money supply. Well, that leads me to the forecast of gold here, and that is, since it's driven by the money supply, holding all things else equal, since I can't predict whether the dollar index will go up or down, and I can't predict whether the stock market will go up and down relative to its valuation. All of that is a set of assumptions. All I can do is track out gold's value over time and hold those variables stable. And what it's saying is that gold will slowly increase over time. The valuation will in the next 3 years. It will basically increase by about, say, $300 an ounce from where it will be at the end of this quarter. But that also means that because gold's price now is about 20%, maybe even 25% lower than where it should be, then we should see a pop in gold. Now, if panic starts to ensue inside of the market, then we can have a run up in the gold price. It does not mean that gold will always hold to its value. It can run as high as double the gold price, or nearly double where the valuation should be. For example, during 2012, when gold had its first run up, my gold valuation model showed that gold should be about $1,000 an ounce, and gold ran up to nearly $1,800 an ounce. That's 80% higher than what the valuation metric should be. The important point to establish is that you're getting bang for your buck by buying gold. But don't expect a complete super rally in the gold price unless if things start to get materially worse. And that's a factor of investor psychology. That is something that psychology doesn't always function well with economic forces that have been quantified. Keep that in mind. It just tells you reliably over time how each variable is affecting that gold price. So I can reliably say that gold should appreciate shortly in the coming months, if not coming couple years. It should appreciate up to $2,300 an ounce, unless if we start seeing this valuation come down. Now, what could cause this valuation to come down? One is an increase in the dollar index. So if the dollar starts rallying and continuing its long-term rally for the last year, that could push up the gold price. Push down the gold valuation. Sorry, not push up the gold price. It would depress. Two is that the stock market, the investors in the stock market, could become overly bullish. It may not function compared to where interest rates say it should be in GDP growth. Investors may be bullish on the economy, in other words. They may think that today's reality is not going to reflect tomorrow's reality, and we care about tomorrow more than we do today, where things are headed, not where things are. And so I think that's one of the reasons why the dollar has rallied. There's an expectation that the price inflation will come down. If it doesn't, then the dollar could drop relative to currencies. And the other thing is that other currencies could fail. Those major currencies may experience higher bouts of inflation, and capital could flow to the U.S., which would depress the gold price. All of those factors are completely unpredictable to the model. I can't put in the assumptions. The only thing I can reliably tell you is that relative to where the model is now, gold is underpriced. So we should see this correction upward very shortly. Maybe not. Sometimes the valuation comes down to meet the gold price. But if it doesn't, and it holds above this, holds well above to where it is now, then we should see gold start soaring over $2,000 an ounce in the coming months and quarters. What about silver? Well, silver functions with the same variables that gold does, okay? And plus one more, and that is because silver is used much more in industrial markets than gold is. Silver needs another component to add to its model, and that is the relationship of the copper price. That is, what I've done is taken an average of the forces that affect gold and an average of the copper price trending over time per ounce, and put that together, and that's how I'm getting silver's value. And you can see here that it functions fairly well, just like it does with gold, in establishing silver's long-term value of price. For example, during the early 1980s, it would have told you that silver was way too high priced. It was very, very high as the Hunt brothers were trying to corner the market there, and they had driven silver up to such excessive valuations that it just wasn't going to hold. Copper wasn't going up as high as the monetary forces and the psychological forces were to buying silver, and it would have warned you, my model would have warned you, that silver was way too high and it was going to come down, and sure enough it did. Also, during the 2000s, just like gold, it would have told you that with silver's ascending value that we should see a run-up in the silver price. We did. And it would have warned you that silver's price was way too high in 2011 and that it would correct down to somewhere around $15 an ounce. Sure enough, silver did. What's it telling you now? Well, much like gold, it's telling you that silver is undervalued. Where the silver price should be right now is about $30 an ounce. But also, because that the major component factor affecting silver is the money supply, also the price of copper, then silver should appreciate over time, and indeed I think it will. But forecasters that are saying that the gold and silver markets are heavily manipulated, that we're expect to see silver soar to over $100 an ounce or $200 an ounce because it's been so underpriced, that's not true according to the valuation metric. Now, it can be true if we start seeing an escalation of silver compared to its value, and indeed during times past, during very strong bull markets, silver would trade at multiples of its value. Back in the 1980s, of course, this was when the Hunt brothers were trying to corner the silver market, silver traded nearly, at its peak, it traded nearly 10 times where it should be. It traded like 7 or 8 times its value. Not saying that that's going to happen today, but a much more reliable metric could be that silver could overshoot its value by more than double during a bull market peak. I cannot predict whether we will see that play out. All I can tell you is that the tool is saying that silver is relatively undervalued, and that the tool's value, this valuation, will appreciate slowly as the money supply goes up, which then brings me to another point. Well, what about the money supply? Well, I'm predicting that the money supply is going to slow right now because the Fed is tamping down on the brakes. They're raising interest rates. They're trying to suck out that excess liquidity. We should be seeing a stagnation in money supply growth. But what happens if the economy starts cratering? What happens if there's a banking crisis and the Fed has to reverse policy? That's not in this model right now. And that could cause the tool's valuation to start to strongly increase, which would signal another bull market to gold and silver. The only thing this thing can do, of course, I can't predict that and when that's going to be. I mean, I could try to price that, and I might do that in a future video and say what happens if the Fed reverses policy. But what I can tell you is that more often than not, gold and silver is priced appropriately according to the fundamental economic forces. Yes, gold is underpriced. Silver is as well. Now's a good buying opportunity, but I am not going to run out on the limb and tell you recklessly that, oh, well, we could see gold soar over to $4,000 an ounce or something, or $3,000. The model doesn't point to that. It can't predict those psychological manic fervors that go into a market that causes that run up. It might, but that's more speculative. Analytically, what it's telling you is that gold is cheap, silver's cheap, great buy right now, but it cannot tell you if it will overshoot or stay underneath its value price. Typically speaking, when gold trades underneath its value price and that valuation starts to increase, gold will increase along with it. It signals a bull market. What are we seeing? We're seeing a rise in this value price, so more than likely we will see gold continue its ascent after it's stalled out. What about silver? Should be much the same. Silver should continue its ascent and should continue to rise over $30 an ounce in the coming years. Gold should continue its ascent and rise over $2,000 an ounce in the coming quarters and years as it starts to reconnect and reconverge with this valuation. The only thing that could derail this is a continuing rally in the dollar index, maybe driven by falling inflation, and a more bullish stock market scenario. So that part can't be predicted, but at least it's given you an idea that right now is probably a good buy. And if I were a betting man, I would say that the forces are going to side with precious metals to continue its push up. Guys, as always, I thank you for watching this video. I hope that you did get some value out of this, knock on wood. If you like my content, make sure you just show me some support. Like this channel, drop me a comment, let me know what you think about all of this. And subscribe to my channel if you really like the information and content that I produce. Click that notification bell so that you're always notified whenever I do upload another video. And I'll talk to you next time.